Hello, everybody. Welcome to today's webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, our webinar title is 5 Key Ratios to Assess the Financial Health of a Stock. My name is Shin Chu. I'm the moderator for this webinar. Now, as an investor, we are often looking for investment-grade companies that are of solid quality. And here are the 5 key ratios that is very essential when it comes to assessing the financial health of a stock. And today our speaker will share with you what exactly are these 5 key ratios that he used. Disclaimer, whatever we share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risk. Allow me to briefly introduce our speaker today. He is a content creator on kclau.com. He has written over 250 articles on kclau.com, and he's also the weekly webinar host and presenter. He is also the co-founder of dividendvault.com, where he manufactures savvy investors who can build dividend-based portfolios independently. He himself is an independent dividend investor, and he primarily invests for dividend income, and his yield is ranging between 2 to 9% per annum. So ladies and gentlemen, he's none other than Mr. Ian Tai. So Ian, how are you today?
Hello, Shane. Hello, everyone. It's good to be back here. I mean, such an honor, such a privilege to be back here, Shane.
All right, so let me just hand over the control to you.
All right, fair enough. Okay, so once again, like I said, it's really a privilege to be here today to actually speak to Bursa's audience. And guys, I mean to say I have actually prepared a lot of materials. So I know that this is a webinar session, but I will treat this as an online training session as well. So guys, if you have a smartphone right beside you, please do make sure that it is actually silent, and as well as you may want to actually pull out the calculator function. Or in fact, if let's say if it's possible, because we are going to do a live demo in this online training session. So what you're doing, guys, is that instead of looking through this online training session on the smartphone, if you happen to be on the laptop, maybe you can actually start pulling out your Excel sheet or your Google spreadsheet. Make sure that that's on standby mode, because as we do the live demo, right, you can actually participate with me and take down some really important notes for this session. All right, because what I'm going to impart to you today is actually live skill. All right, real skills that you can actually use for your own self when it comes to building your own stock portfolio. Okay, so this is actually not just you sit back, relax, and just enjoy the session. There is a practical part to this online training or webinar session. Now with that, let's move on, because I've actually prepared a lot of materials for you guys. Oh yes, one more thing. Before I continue, if you want to interact with me, just use the chat box. And if you happen to have any questions, just feel free to put your questions in the Q&A box. All right, with that, let's begin. So I would like to begin this webinar session with a warm-up question. So the question is as follows. What is the secret sauce to building and managing a profitable stock portfolio? Okay, so let me repeat the question. What is the secret sauce to building and managing a profitable stock portfolio? All right, so I have listed down possible answers, and these answers are as follows. Could they be any one of these following? Number 1, stock tips. Number 2, buy-sell recommendations with target prices. Number 3, technical analysis. Like for example, some people may want to use moving average or MA. Some people are into Fibonacci. Some people are looking at chart patterns and so on and so forth in order to actually build or manage a stock portfolio. Number 4, some of you may actually believe that you really need market predictions. You want to know what's going to happen in the future, all right, where the market is going, what is the economy doing, what's the central bank is going to do, and all these things are factored in order to, all these things need to be factored in order to make good investment decisions. Okay. Number 5, financial newspapers. Number 6, you may want to, number 6, You may actually rely on your family members, your friends, your colleagues, even social media, all right? Like all the gurus that appear on social media. Could they be the secret sauce to successful stock investing? And last but not least, how many of you actually receive advice, all right? Maybe it's through a registered financial planner, or maybe it's through an investment advisor. Yep, so these are the possible answers that you may answer when it comes to the secret sauce. So guys, if you are using any of the 7, type in the chat box, let me know. Which of these do you think are helpful, all right? Or they have contributed, or you think that they will contribute to the success of an investor, all right? Type in the chat box. Which of the few that you think is actually workable? Okay, so we have our first respondee. So Wong says 3, all right, which is technical analysis. Fazli says 3, 4, and 5, which is technical analysis, market predictions, and financial newspapers. Kelvin Yong says 3. Eun Seng Hock says financial newspapers, which is 5. Kelvin Chow, 3. Augustine, 4, 7, and 5. Or 4, 5, and 7, which is market predictions, financial newspapers, and financial planners. To Xin Hui, 3, 4, 5, which is technical analysis, market predictions, and financial newspapers. So most people are in the 3, the 4, and the 5 category. Okay, so very few. Okay, so there are a few people. William Wee and Gan Kok Cheng says 2. All right, so there's some people who wanted buy-sell recommendations with target prices, but their tools is also mixed up with technical analysis and market predictions. All right, fair enough. So, okay, guys, thank you so much for the response. All right, so I guess that this is actually more like a sharing session also, because I'll be sharing with you, exchanging ideas with you when it comes to building and managing a stock portfolio. Okay, so what will be my answer? Okay, so here are as follows. So the thing is that personally, because I mean to say, when it comes to investment decisions, these are decisions that are very personal. So I would say that I can only speak on behalf of myself. So for me, right, when it comes to the 7 possible answers that I have listed down, so my answer is actually no. So which means to say I actually don't rely on any of this 1, 2, 3, 4, 5, 6, 7 in order to make investment decisions. And the reason is this, okay? And the reason is that personally, I tend to be a little bit different, all right? Because I don't actually necessarily rely on stock tips, buy-sell recommendations, technical analysis. So if you ask me whether or not I know how to do technical analysis, the answer is no. Do I know how to use MA, Fibonacci, stochastics, and all these tools, all these sophisticated tools in order to execute any trade? The answer is no, I don't really know how to do that. Do I do market predictions? The answer is no. Do I read financial newspapers? The answer is yes, but do I really rely on them to actually make good investment decisions? The answer is no. So how about family, friends, colleagues, and gurus? The answer is also no, so I don't really depend on them. And last but not least, financial planners, advisors. Do I really rely on them? So the answer is no. So the thing is that after this webinar session, right, what happened is that you will be imparted with a life skill. And the life skill that I'm about to impart to you guys is one that will enable you to actually make better investment decisions. And these kind of decisions, right, these kind of decisions are made without any of this. So which means to say, after this 1 hour session or so, you can, you can make more confident decisions. And these decisions, right, are not based on stock tips, buy-sell recommendations, technical analysis. You don't really need to invest in a highly sophisticated charting software in order to make good decisions. You don't need to actually predict where the market is going. You don't really need to actually look at the newspaper or brokerage reports and whatnot to actually find good stocks and whatnot. You don't actually need to really rely on friends, families, family members, colleagues, gurus, on the lunch table, or on the dining table in order to make good decisions. And last but not least, you don't really need to actually rely on financial planners. So that is actually the kind of skill within 1 hour, I'm going to just impart it to you today. All right. So for me, what is the secret weapon that I personally use in order to build and manage a stock portfolio? So this is actually my secret sauce, which is actually tied up to today's topic, whereby the secret sauce that I use to actually invest in stocks is actually financial statements. So which means to say, to me, I will rank the ability to actually read and interpret financial statements as the number one secret weapon, the number one superpower when it comes to investing in the stock market. So to me, reading financial statements is actually quite essential. If I know how to read them, I can invest. If I do not know how to read financial statements, I don't dare to invest. Okay. So my investment decisions are actually very, very highly dependent on the stock's financial strength, the stock's fundamental qualities. All right. So that is actually my secret weapon. Okay. So today, the skill that I'm going to impart to you would be the skill of reading financial statements. Okay. Now, here is the outline for this webinar. So in this webinar session, I will be covering the following. So number one, I would like to discuss with all of you I would like to also explain why smarter investors, all right? So people like myself, people like I wouldn't say that I got this by myself, because for me, what I believe is this: people who are successful, right, they tend to learn from another person who is more successful. And people who are more successful will tend to actually learn from people who are a lot more successful, all right? So it's kind of like success begets success, wealth begets wealth, all right? So it's that kind of analogy, all right? So all these things I didn't really make up. It's more of an attitude whereby you want to be successful, you want to be good in the art of stock investing, then you learn from someone who is actually achieving or attaining that kind of success. All right. So it's all something like that. So it's actually the same with my boss, which is Casey Lau himself. He is also learning from someone. So the story is this. So the bottom line is this. So for people who want to be successful, that's why you are here today. You want to learn from people who have achieved certain kind of results, who achieve certain kind of success, so that you can actually copy and paste and work it out for yourself. Okay, so today I'm going to also cover why smarter investors tend to read financial statements before investing in stock. Number two, I will give you a brief introduction to financial statements. All right, so this brief introduction is actually very important because it allows you to understand, oh, this is how you read financial statements. Okay, and once you have the brief introduction, then we go into the practical part where we are going to do a live demo. And I'm going to show you how do I personally read the financial statement of an actual stock. Okay, so we will do a live demo. So that's why, guys, Excel sheets, Google spreadsheet, open it up, and you can actually follow this webinar and take down some notes together with me. Okay, and as I do the live demo, we are going to talk about the 5 key financial ratios that I use. Okay, and we are going to do some calculation. So that's why if you have that Excel sheet or the Google spreadsheet, it will be very handy. And last but not least, what happens after we have calculated the 5 key financial ratios? So what do we do after we actually found ourselves a good stock? Okay, so that one we will actually address that right at the end of this webinar session. Okay, and now, okay, so I've a bit jumped the gun for this webinar session. So if you can see, once you know how to do all these things right, you will be able to identify financially solid stocks all by yourself. Okay, and you can ditch the need for stock tips, buy, sell recommendations. You don't really need them. You don't really need technical analysis anymore. Market predictions, you don't really need to predict the ups and downs of the stock market. It's actually quite irrelevant after 1 hour. And last but not least, you can stay away from unsolicited investment advisors from family, friends, colleagues, financial planners, gurus, and YouTubers, and all this kind of stuff. You don't really need them anymore. Okay. So all these people will be redundant after 1 hour. Okay. Now, I'm going to just put a caveat here. Okay. So this skill is only good and useful for people, okay, for people who are sincere in building an investment portfolio, okay. So I put this caveat up right up front first. It's actually meant for investors. It's actually meant for people who want to build long-term wealth from stock investing. It is for people who also want to build a steady stream of passive income, like dividends from a stock portfolio. Okay. And it is also for people who want to achieve or who is aiming to achieve sustainable capital gains from their stock portfolio, whereby the time horizon is actually quite long. And how long is long? It's kind of like forever. It can be 5, 10, 20 years down the road. Okay. So there's no short-term quick profits, that kind of stuff. So guys, if you are into you want to have the faster money, you want to get, how do you get trading gains very quickly and all this kind of stuff, this webinar may not be so suitable for you lah. Okay. Why is that? Because if I go all the way back to my introduction, so the key thing here is that I invest primarily for dividend income. All right. So which means to say currently my stock portfolio, it just pays me dividends on a quarterly, half yearly, annual basis. All right. So every few months, probably about 8 to 9 months. Like let's say, for example, 1 year we have 12 months, 8 or 9 out of these 12 months, I will receive my dividend income. So that is actually the result I'm getting. All right. So if you ask me about how do you buy a stock at $1 and sell it at $2 in no time or in 6 months, I don't know. Okay. So that is actually the caveat, all right, that I'm putting up front. So if you're into trading and you want to do that kind of fast-paced trading and whatnot, then this webinar is not so suitable lah. Okay. Now with that, let's move on. Now let's start off with part 1. Why do smart investors read financial statements? Okay. So over here, I will explain, all right, why is it possible for investors who read financial statements, after they have read financial statements, they tend to identify stocks, and after that, after they have invested into them, they could actually attain better capital appreciation. They can earn regular dividend yields, which is like what I'm doing right now. So they can actually get better capital appreciation, they earn regular dividends, and at the same time, they can reduce significantly the risk of investing in the stock market. So I will be explaining the law in the most logical, sensible manner why this is actually possible. Okay. And number 2, I will also explain how most investors who do not read financial statements, they tend to fail to achieve both sustainable capital appreciation and dividend yields for the long term. Okay. So the thing is that you can see that investors who read financial statements, they tend to be winners in the stock market. Investors who don't read financial statements, they tend to lose out. In fact, they lose out the bigger money in the stock market. So I will explain that right now. Now let's start with capital appreciation. Okay. So basically, right, when it comes to stock market and when it comes to stock investing, right, there are 2 reasons why people want to invest in the stock market. The first one is capital appreciation. The second one is dividends. So let's talk about capital appreciation first. Now, when it comes to capital appreciation, there are 2 types of capital appreciation. Okay. So the first one, I call it sustainable. Okay. Why is it sustainable? Because the capital appreciation is sustainable simply because this kind of capital appreciation is backed by long-term business growth. Okay. So note that down. 2 types of capital appreciation. One is sustainable because it's backed by long-term business growth. The second one is unsustainable. Why is it unsustainable? Because it is fueled by greed. It is fueled by a sense or a desire to actually make quick money. So there are people who actually come into the stock market to do that. So that's why sometimes you can see that a lot of stocks go up very quickly, and as quickly as it has risen, it kind of like dropped as quickly as well. All right. So that is unsustainable. Now, I'm going to explain to you how capital gains are achieved over the long term, and it can be sustainable. But in order to do that, I will use the analogy of a property, all right, property investment. So which means, say over here, I'm going to just sidetrack a little bit. The reason why I want to sidetrack is simply because I want you to understand from my point of view, how it works, why a certain asset, be it property or be it stocks, how come they can actually achieve, how come they can attain capital growth or capital appreciation on a sustainable basis. Now, let's look at it from an angle of a property investment. Okay, so take out your calculator, you're going to do some maths. Now, I'm going to just give you a mathematical question. I know it's nighttime, right? So, but don't worry, this mathematical question is very simple. Okay, just you just open up the calculator function of the smartphone, and then you can actually get the answer. All right. Now, here's the question. Supposedly you kind of like invested in a property. So this is year one. So whereby this is a property, let's say an apartment in Malaysia. So the price that you pay is actually 240,000. Okay. So it's a small property, price at 240,000. Okay. And you kind of like expect it to yield 5% per annum. Okay, so 240,000 in price. That's the price you pay. All right, the expected rental yield is 5%. So which means to say the annual rent that you are expecting to collect, all right, or you're collecting is 12,000 per annum. So if we divide 12,000 per annum with 12 months, so which means the monthly rent is 1,000 ringgit. Okay, so now the thing is that for this property, okay, now you have been collecting rent since day one after you have received the keys to your property. You receive a monthly rent of 1,000 ringgit per month. And now let's say 2 years down the road, after 2 years of holding onto this property, the monthly rent, you increase it by 10% from 1,000 ringgit to 1,100 ringgit. And 2 years subsequent to that, which is at the 4th year, you increase the rent from 1,001 to 1,002. And at the 6th year, so after holding onto this property for 6 years, you increase the rent from 1,002 to 1,003. At the 8th year, you increase from 1,003 to 1,004. And finally, at the 10th year, you increase the rent from 1,004 to 1,005. All right. So now we are at this stage. Now, after 10 years, the property that you have invested 10 years ago now gives you a rental income of 1,005 a month. And the annual rent is 18,000 a year. So now every year you collect 18,000 ringgit a year. Now, let's say that it is still conventional for the market to actually expect a 5% rental yield for this property. So the question that I would like to ask all of you is this: what would be the market value for this property? Type in the chat box. Let me know. How much would you pay? Okay, how much would you pay for this property, this same property that the investor has actually paid for 10 years ago at 240,000? Okay. Now, after 10 years, what will be the property price? So I am actually seeing that a lot of answers, all same answers, which is 360,000. So the answer is correct. Wong Kok Leong says 1 million. So that's not right. Okay. 360,000 will be a fair answer. Okay. Kelvin says 300,000, so that's not correct. It's actually 360. Okay, so how do you get this 360? Now, guys, if you take 360, you times an annual rental yield of 5%, you will get an annual rent of 18,000, which works out to be a monthly rent of 1,005. Okay, so that is actually how it works. So what you do with your calculator is that you punch in 1,005, multiply with 12 months, you get 18,000, and then you divide it by 5% yield. So therefore, your market value Okay, the market value of the property is 360,000. Okay, so that is actually just simple mathematics. All right, now let's move on. So what it means here is this: sustainable capital appreciation is actually led by sustainable growth in income production. Okay, let me repeat this again. Sustainable capital appreciation is led mostly by sustainable growth in income production. Okay, so capital gains and income production goes hand in hand one. Okay, so if you want to have sustainable capital appreciation, be it from your properties or your stocks, just focus on income production. Okay, as long as the asset can continue to actually grow when it comes to its income production, be its profits, be its operating cash flow, slowly, okay, the market value of the asset, be a property or a stock, will reflect by itself. Okay, so that is actually the equation. Now let's look at the example. So of course, there's a caveat. We are not recommending any stock to buy or sell in this webinar session. I'm just here to put forth a point. Okay. Now this is actually an example of a case where capital appreciation is sustainable. So let me just tell you the story. So this is public bank. So now the price. So as I prepared the slide, public bank was trading at 392. So it's here. But if you look back so many years ago, which is let's see what I put here. I put all the way back to 2006. So in 2006, public bank, it earned 1.73 billion ringgit. Earnings per share at the time has been adjusted to 8.9 cents because of the bonus issues and all this kind of stuff. So based on, if let's say we are basing on the latest number of shares, the earnings per share is actually adjusted to 8.9 cents. And at that time, the stock price at that time was 1.41, okay, 1 ringgit and 41 cents. So it's over here. Of course, this stock price has been adjusted for. Now, fast forward to 16 years down the road. After 16 years, public bank, when it comes to its earnings or income production, it has actually increased from 1.73 billion to 6.12 billion. So 1.73 all the way up to 6.12. Okay. So as you can see, the earnings have actually grown at 3.5%, 3.5 times. Okay. So it's a multiple of 3.5 times in terms of growth when it comes to income production or earnings. Now, when it comes to stock price, it has actually increased by 2.8 times from 1.41 to 3.92. Okay. So as you can see, this is actually a classic example of sustainable growth in income production leads to sustainable capital appreciation. Okay. So this is actually how it works for public bank when it comes to its shareholders' earnings. As you can see on this graph, it's just one straight line like that. Okay, very nice graph. It's just, you can see that earnings just keep on rising on a year-on-year basis all the way up to 2022. So for most value investors like myself, this will be the most ideal lah. Okay, of course, after all, the reason why we actually invest is the reason why we invest is simply because we want to participate in the growth, the business growth, the earnings growth, the income production growth of the company. So therefore, when public bank, if I have the chance to actually invest in public bank in 2006 and I just hold it for 16 years, so this will be the earnings that I will be participating in when it comes to public bank. All right. So that's how many people, okay, especially old uncles and old aunties, right? If you go to public banks AGM, a lot of millionaires over there, a lot of people who actually participated in that AGM, they have lots of public bank shares, and I think that public bank shares could have been, might possibly be retained in their retirement portfolio today. Okay, so that's how wealth is actually built, grown, sustained over the long term through stock investing. Okay. Now, let me just share with you what is what is it like when it comes to unsustainable capital appreciation? Now take a look at this. Now, no comments on the fundamentals of Top Glove. Okay, so not saying that Top Glove is fundamentally good or fundamentally bad, but I'm just here to actually point out something lah. And I just want to share with you what does it mean by unsustainable capital appreciation. So here I would like to just point out this particular time where it is COVID-19. So as you can see, Top Glove has a rocket growth in terms of its stock price during COVID-19, and subsequently after that it kind of like fallen from grace, all right, dropping from a very high price to today, which is about 80 cents, 84 cents. So the thing is that why is there a huge growth in terms of stock price over here? And why after a huge growth in stock price, there's a huge downfall in stock price? All right. Is the company any better? Is the company any different or fundamentally different before and after? So my take is that actually for all this kind of thing, right, it has very little to do with the company itself. All right. It's not the company's fault. It's not the company's doing for this kind of stock price movement, but rather it is actually a reflection of people's greed. All right. So when the stock price is actually increasing like this at such a high pace, at such a fast pace, it is actually a reflection of greed and speculation in the stock market over here. All right. So typically at this stage, many investors, the savvy ones, will see this as overvalued. So it was actually a good chance for people who actually bought into Top Glove to dispose it for capital gains, all right, to realize their investment rewards. And as for the drop in stock price, that actually is a reflection where people are no longer interested. People do not actually believe that Top Glove would actually have a meteoric rise anymore, so therefore they just dump the stock. So these are people who are actually more short-sighted. They have a more short-term view when it comes to stock buying or selling. So therefore that explains everything lah. That explains why the capital gains or why the capital appreciation in Top Glove is unsustainable. It has nothing to do with Top Glove, but it has everything to do with the market, whereby it's all about fear and greed. It's emotions lah. Okay. So just now I talked about the first part, which is capital appreciation. Now we talk about dividend yields. So let's take a look at public bank. So this is why smart investors tend to read financial statements. And the reason is this, okay? So if you look at, so this is actually a graph, and all these data are actually taken from public bank, obviously. So this is actually a reflection of people who actually read financial statements. When people read financial statements, they tend to know about this. Say, oh, this is how much public bank is making on a yearly basis. And and on a yearly basis, because of an increase in earnings, therefore what we can see is that the more the stock increase when it comes to its earnings, income production, the more it pays out when it comes to its dividends per share. So for dividend investors like us, so imagine you have actually bought it at 2006. The more the stock makes in terms of earnings and income production, the more dividends it can pay out to its shareholders, okay, to investors. Okay. So why do investors read financial statements? It's simply because if they know that the company can actually produce such increase in income, they can actually see that their dividend income will also increase. Okay. How long? For as long as they hold on to the stock lah. So imagine people hold on to public bank for 16 years. During the period from 2006 to 2022, they will have gotten 16 years worth of dividends. Okay, it doesn't really matter what the technical analysis says. what the chart is actually saying. It doesn't matter what the newspaper is saying. It doesn't matter who is running this country. It doesn't matter what the central bank, what Bank Negara is going to do when it comes to interest rates. All these are irrelevant anymore. As long as you hold on to a fundamentally solid stock, all these things are not as vital anymore. All right. What is vital is that the stock. So what is vital is this: as long as you keep on reading financial statements, as long as you make sure that the company that you hold on to, they continue to increase their income, then your dividends will follow. It's as simple as that. And not just your dividends are going to follow. Of course, you will also, in the meantime, as you collect your dividends, the stock price will also increase. So you're not just getting a stock price increment of 2.8 times. Imagine the amount of dividends you are going to collect for the next 16 years. Okay, for this 16 years period, how much dividends are you going to collect? All right, would that be significant in contributing to your financial life? I would say yes. And guess what? Does it end here? The answer is no. All right, the answer is no. Public Bank is still around, and Public Bank will continue to actually just do its business. Sure enough, as at this stage, Public Bank, I mean to say, last year it has reported $6.1 billion in earnings. Of course, there's no, we couldn't actually speculate how much it will continue to actually earn in the future. But that's where investors come in and just assess the business fundamentals, to actually see whether or not Public Bank can actually continue on this business growth, and then from there they will make a decision out of it. Okay, so this is actually why investors read financial statements. Okay, so here is just to reiterate or just to repeat whatever I've just mentioned. Why financial statements? Number one, we read financial statements simply because we want to identify stocks that grow profits consistently. And why do we do that? And why do we do so? It's simply because when we identify a stock that could grow its profits consistently, like 10 years, 20 years, and all this kind of stuff, all right, growth in profits will bring in growth in dividend income. That's number one. Number two, growth in profits we also hope that, okay, but there's no guarantee, we also hope that there will be sustainable capital appreciation. But as we wait, we just collect the dividends, okay? So that is actually why we read financial statements. Now, without reading financial statements, what happens is this. Most people who actually don't read financial statements, they couldn't tell the difference between maybe AirAsia with Public Bank, with, let's say, an oil and gas company like Petronas, or a Petronas with a property development company, or a property development company with a retail company, or a retail company with a trading company, with a logistics company, with a manufacturing company. They don't know because they don't read financial statement. So when you don't know, you just buy and tembak lah. Okay, you just buy stocks, whatever you just buy stocks aimlessly in the stock market because you couldn't tell the difference between a bank and a REIT from a trading company, a retail company, or even a conglomerate. How will you know? So since you do not know, you just bantai lah, right? So that is actually what most people do. They just bantai stocks in the stock market aimlessly. So when they don't read financial statements, what happens is that most of the decisions are made based on stock price. So when you make decisions based on stock price, then very obviously you're going to use charting softwares. You're going to use Fibonacci's, moving averages. You got to use stochastics. You're going to try to predict where the stock price is going to go all the time in order to make a decision. Okay, so that is actually what happens when people don't read financial statements. They tend to actually look at stock price or price charts in order to make decisions. Okay, and if people actually don't read financial statements, what happens is that they also couldn't tell the difference between a good stock or a bad stock. So that's why they need tips and recommendation. And guys, here's the thing. When you don't read financial statements, it is actually the reason why and how most people lose money in the stock market, because they do not know that they might have actually bought into stocks that are fundamentally not sound, they are financially poor, and they kind of like invested their capital into that, and they have lost money as a result of it. Okay, so that is why for me, I stress a lot about financial statements. I stress a lot about the importance of reading this. If you read this, then you kind of like have a huge advantage over many people when it comes to this art of stock investing. Okay, now having said about the why, now let's move on to part 2, where we are going to talk about the basic introduction of financial statements. Okay, now two things that, now when it comes to financial statements, we got to be very objective based. When it comes to that, we want to know why are we actually reading financial statements, and there are two main reasons for it. The first one is actually we are looking for profitability, which means we want the stocks to actually grow in terms of its profits over the long term. So we are going to look at profitability. Number 2, we want the stock to be resilient. Resilient simply means that we want the balance sheet of the stock, we want the stock's finances to be strong, so that just in case there's another COVID situation, there's an economic crisis, or there's a financial downturn, then the stock has a bigger chance. It's more likely to survive. Okay, so that's called resilience. So profitability is about offense, it's about the returns. The second one, which is resilience, is about the defense. Okay, so one offense, one defense. Okay, now when it comes to profitability, the thing is that we will look into 3 things. Number 1, sales. Number 2, profits. And number 3, operating cash flow. Okay, let me repeat this again. There are 3 things, 3 very important things that we look at in a financial statement of a stock when it comes to profitability. The first one is sales, the second one is profits, the third one is operating cash flow. And where do we get this kind of information? In a financial statement, we will look at sales and profits from the income statement, and we look at operating cash flows from the cash flow statement. Okay, so sales and profits from the income statement, the operating cash flows, cash flow statement. Okay, so that is actually number 1 when it comes to profitability. Number 2, we look at resilience. How do we measure resilience? Number 1, we look at short-term liquidity, which means the ability of the stock to pay its bills in the short term. Short term here simply means 12 months. So which means to say, like, let's say for example, let's say today I have annual expenses. My annual living expenses is 100,000. And let's say I have $100,000 in my bank account. So which means to say my $100,000 in the bank account can actually be used to pay for my annual living expenses. So that is actually what it means by short-term liquidity. Debt levels is also very important to measure that as an investor, simply because you want the company that you invest in to be conservative when it comes to debt. Okay, conservative and responsible when it comes to using debt. So how do we measure liquidity and debt levels? That's where we look at balance sheet. Okay, and now with that, let's look into the live demo. Okay, so the live demo will be it will take some time. Okay, so Shane, I know that it's 9:20, so I would be taking a little bit more time in order to do the live demo. And with that, let's get into this live demo. Get ready for when it comes to your Google Sheet and your Excel sheet. I'm gonna do the live demo right now. Okay. And in this live demo, what I'm going to do is that we're going to read and interpret together a real life financial statement of a stock. And number 2, we're going to calculate the key financial ratios for the stock. Okay, with that, let's get into it. Okay, so this is actually a blank sheet over here. All right, so hold on. Okay, oops. All right, sorry. Okay, so this is actually a blank sheet of, this is a blank sheet. So of course here I have actually done some notes. So I'm just gonna, later I'll review it to you. All right, so here's a blank sheet. Now, the stock that I would like to use as a case study today, okay, would be this. Okay, so guys, if you do not know how to come to this page, why is it there? It's simply because it has been saved in my Google. So if let's say you are a new investor today, what you can do is that at this tab over here, just put in Bursa Malaysia, click onto the Bursa Malaysia website. All right, you will see company announcements over here. Just click onto that. Okay, so here you can choose a company. Today I will be doing a case study on Tongguan Industries. So it is actually a plastic packaging company that I will be doing today. Now, in order to understand financial statements, I'm going to just look at this annual report. So click onto annual report and then click onto search. Now you will be given annual reports for the longest time. So typically what investors will do is that we will actually take a period of 10 years. Okay. So it's from 2022 all the way down to 2013 or 2012. Okay. So we'll take these 10 annual reports. We will assess the fundamentals of the company. Now I'm going to just click onto the latest one. And as you can see, you will be given PDF files. So sometimes you have part 1 and part 2. So usually the financial statements will be presented in part 2. So I'm going to just click onto that and open the PDF. Okay, now let's go down. So typically the financial statements will be somewhere around here, which is a little bit at the center, right? It's usually smack right center at one's annual report. So we are going to go into that. Okay, so as you can see, we have a few statements. The first one is actually statements of financial position. So this one, let me just pull back the slides a bit. So statement of financial position is actually balance sheet. Okay. Statement of financial position is actually balance sheet. Statements of profit or loss and other comprehensive income is income statement. And last but not least, we forget about, okay, we will not actually look at statements of changes in equity today, but rather we will look at statements of cash flow. So this one is cash flow statement. Now, according to this, I'm going to just put this slide here just to retain it. Now, the thing is that we will go through this on a step-by-step basis. Number 1, we will look at profitability. Number 2, we will look at resilience. All right, so let's start with profitability. Then we move on to this. In terms of profitability, okay, we look at statements of profit or loss and other comprehensive income. Now, the thing here is that how to read this. Okay, so if you want a shortcut version, here's how you can do this. Okay, so here, so I'm going to give you a live demo on how to do this. We have year, we have revenue, and then we have profit for the year. So we just put that profit for the year. Okay. So you may want to actually copy this. I'm just going to go slow. So the thing is that since this is actually reported in RM thousands, so I'm just going to copy and paste that. Okay. So typically, a financial statement like this, can you see that there are 2 years, 2022 and 2021? So typically, every single financial statement, right, it will be reported in 2 years. So it will be 2021 and 2022. Now, the next thing that I would like to highlight to you is that there is group and company. So what does it mean? So today we are going to do Tongguan Industries Berhad. Okay, but Tongguan Industries Berhad has many subsidiaries. So what happens is that company simply means Tongguan Industries Berhad itself, only the entity. But if you took out, but then, so company refers to that entity, which is Tongguan Industries Berhad. Now, when it comes to group, group simply means the entity plus all the subsidiaries, all the Sendirian Berhads that the company owns. Okay, so that one is called group. So where will investors focus on? Investors will tend to focus on group. okay, which is all here, okay. Now, so at this stage, what do we do? Well, we just compile the data. So let's say, for example, revenue for 2022 is 1,386,523. So which means to say in 2022, the company has made $1.39 billion in sales. Okay, so with that, I'm gonna just copy and paste this. Okay, 1,386,523. As for 2021, it is 1,214,944. All right. Now, over here, this is sales, but of course, like many other businesses, there are going to be costs incurred. And after they have incurred all the costs, all right, they will have to pay some interest, they will have to pay taxes, and finally they are down to the profit for the year, which is this. Okay. So profit for the year for Tongguan is actually 101,661. So over here, I'm going to just copy and paste that. Okay. Likewise, I'm going to copy this figure as well. So what it means is that for Tongguan, okay, Tongguan has made 101.6 or 101.7 million ringgit in profit for the year. And for the year before that, which is 2021, it made 98 million. Okay. So now we can actually calculate the first key ratio. So the first key ratio that I would like to highlight to you is net profit margin. Okay, and net profit margin is actually in percentage. Okay, so what happened is that in order to calculate net profit margin, what we do is we take D4, divide by, we take the profit, which is 98, if it's for 2021, or let's just do with 2022 first, okay? We take D5, which is profit for the year, 101.7 million. We divide it by C5, okay? Then we have 7.33%. So what it means to say is that for every $100 it make in sales, its net profit is actually 7.33. $100 in sales, it makes $7. Okay, it makes $7 in net profit. Okay, and the convenient thing about using a spreadsheet like this is that if you just move it up, then we can see that the net profit margin for 2021 is 8.07%. Okay, so with that we can actually, we just continue on. Can you see that we have 2022, 2001, we have 2022, 2029, 2019, 2018, 2017, and all this. So all we need to do is just go back up. We just need to just do some data entry. In order to get the answer. So over here, I have actually prepared, all right, I have prepared the data for you guys. So it's all here. So after you have compiled that, all right, you can see that, oh, okay, you can actually assess whether or not Tongguan Industries have actually generated increasing sales and increasing profits over the last 10 years. Okay, it's as simple as that. You just need to compile this figure, and then you can actually make your own conclusion out of this data that is being compiled. And then when it comes to net profit margin, all you need to do is just go up like this. And from there, you can see whether or not the net profit margin for this company, has it increased, has it improved, or has it deteriorated? If it improved, that means to say, hey, cost control is good. Operating margins, profit margins has increased. Very good. Then you may want to investigate why. But if let's say you find out that profits are declining, net profit margin is actually shrinking, then you may actually want to reconsider whether or not you should be investing in this company or not. Okay, so that is actually the first key financial ratio, which is net profit margin. Now, next, okay, here I'm going to just review to you a simple formula in order to calculate the compounded annual growth rate of Tongguan Industries perhaps sales and profits. Now let's get into that. Okay, so I'm going to just demonstrate to you how you can actually compute the CAGR of its sales and profits. Okay, right now in this Excel spreadsheet. Okay, what you need to do is just click onto enter, double bracket. So compound annual growth rate, right? How is it calculated is this. Okay, so you take the end value, which is C13. You divide it by the beginning value, which is C4. Okay, close the bracket. Okay, do this small little arrow. Click onto this small arrow, which is like Shift 6. Open bracket again. All right, 1/period. Period means period of time. So we are measuring the period, the growth period between 2013 to 2022. So in order to calculate the growth, how many periods is actually here? So over here, we can see that it is actually 9 years. So what we do with that, we just put in 9, close the bracket, double close the bracket, and then -1. And there you go. So what I have calculated is that for the past 9 years or 10 years over here, Tongguan Industry has actually increased its sales by a compounded annual growth rate of 7.55%. Now, in order to calculate the compound growth rate, annual growth rate for its profits, what you can do is that you can take this, you just move this, you can just move this like what I have done, okay? And there you go. The compound annual growth rate for Tongguan Industry Berhad, when it comes to its profit, is actually 15.03%. Okay, so this is actually the CAGR. Okay, so far so good. So if you know how to calculate net profit margin, that's ratio number 1. If you know how to calculate compound annual growth rate, that will be ratio number 2. All right, so with that, I'm gonna actually move on to the next ratio. So bear with me because I know that it's 9:36. So let me just continue on. I will try my best to actually impart as many stuff as I possibly can in this webinar session. Now, let's move on. The next ratio that I would like to calculate is actually return on equity. So how do we actually calculate that? Now, notice this. So we have profit for the year for 2022 is actually 101.7 million. But over here, we can see that this 101,661, which is the same figure here, is broken down into 2, which is number 1, profit attributable to owners of the company, which is 99.9 million. And then we have 1.7 million, which is belonging to the non-controlling interest. So what does it mean? Well, let me just explain to you in another sheet. Okay, so supposedly I own, let's say for example, there is this company called Ian Berhad. Okay, and Ian Berhad does revenue, has its costs and profits. All right, so there's this tree over here. Now, the thing is that Ian Berhad, right, owns the following subsidiary. Number 1, A Sendirian Berhad. Number 2, B Sendirian Berhad. Okay, so so Ian Berhad owns 2 subsidiaries, A Sendirian Berhad and B Sendirian Berhad. Now, A Sendirian Berhad, Ian Tai owns everything, 100%. Okay. As for B Sendirian Berhad, it owns 80%. Okay. Now, for A Sendirian Berhad, it made 100 million. The cost is actually 90 million. So the profit is 10. Whereas for B Sendirian Berhad, it made 100 million. Cost also 90 million. The profit is also 10. Okay. So typically, how does Ian Berhad report the financial statement? Let me share with you. So when it comes to the group, here's what we do. We don't actually do this. We don't actually take C5, which is this A Sendirian Berhad, plus 80% of D5. So we don't actually report. So we don't actually report this way. You say, oh, this is 100% of 100, and then we have 80% of 100. So therefore, it is actually 180. So that's not what we do. Instead, what we do here is that we straight away say 100 plus 100, 200. When it comes to the cost, 90 plus 90, so it's minus 180. When it comes to profits, here is 20. So over here, we have owners, but instead, what we do is that we will single out. But then the thing is that you see the 10 million here? This 10 million, right? 80% is ours. The 2 million is not ours. It's not mine. So we take the 2 million, we put it here. So actually, then this 20, right? We'll just bring it down over here. 20 minus 2 for the owners. We'll report it this way. So the owners will earn 18 million. So that is actually the difference. Okay. So this is actually, so let me repeat. So this or this is actually this. As for profit attributable to owners of the company, which is this, it's here. Okay. I know it's a bit complicated, but you just view the video again in order to actually digest this information. Okay, so here I will actually compile this figure, which is 99,948. Okay, so here we'll go back. We'll just say shareholders, and we will say profit attributable to owners. So over here, what happened is that we have 99. Over here, we have 92876. Okay. Now, in order to actually calculate return on equity, we need this formula. First, we have the profit attributable to owners. The second one is that we have to go to the balance sheet, which is the statements of financial position, in order to get this figure, which is total equity attributable to owners of the company, which is shareholders' equity. So it's over here. So what we do is that we will compile this figure. Okay. So let's say, for example, we have 821060, and over here, so this is actually for 2022. For 2021, it's actually here, which is 733,800. So we just compile that. So when it comes to return on equity, which is measured on a percentage, what we do is that we take F13, we divide by G13. So it's at, so the answer is 12.17. So what does it mean? It means that every $100 invested by shareholders, the company can actually generate 12 ringgit or $12 in earnings back to its shareholders. Okay, so the question is, how sustainable is this figure? Is this figure increasing? Is this figure decreasing? Is it stable or is it not stable? Is it consistent or is it not consistent? So therefore, we actually look back for the past 10 years to actually find out this kind of information. And to do that, and if you want to do that, I already kind of like compiled the information over here. So we just, so all you need to do is just go back to all these annual reports, just download these PDFs, and then you kind of like copy and paste all these figures into your Excel sheet like this. Then you can calculate the return on equity, and therefore you can actually make your own conclusion from this data by itself. Okay, so over here, what we can see is that the return on equity, you can see over here, number one is positive. Number two, it is actually kind of like stable. So this is actually the two things that, or in fact, we have the third thing, which is the return on equity has kind of like increased slightly over time. So I would say that if it's positive, it's consistent, and if it's increasing, then it's usually a good sign for investors. If the return on equity is declining, inconsistent, or in fact, if it turns out to be negative, then it can be a red flag. It can be a warning sign saying, hey, will I be investing in this kind of company? So that is actually return on equity. Okay. So make sure that this is actually positive, consistent, and increasing. So that is the third, that is actually the third, how would I say, the third financial ratio. Now with that, let's move on to the next one. Okay, so the next one is this. So now we have done with the sales and profits. Operating cash flow, hold on to it first. We are going to go all the way to short-term liquidity. Okay, so how do we actually calculate? How do we measure short-term liquidity? Well, this is as follows. So the thing that we need is actually number one, current assets. Number two, we need current liabilities. Okay, so current assets are assets that can be liquidated in 12 months, or that means to say they own something that is either cash or something that can be converted into cash within 12 months. Okay, so here are the list of current assets. So for example, inventories. Inventories can be converted into cash simply because they are now in sale. Trade receivable means it's already sold to customers, but then you already build the customers are actually promising the business to actually pay their bills within 12 months. So that is actually trade receivables. And of course, we have cash and cash equivalent. So all these things added up together, it will be current asset. So what we do here is that in order to measure short-term liquidity, we just take this figure, which is 853,430. Okay, that's for 2022. And for 2021, we take 817,604. And now when it comes to current liabilities, all right, it's over here. Current liabilities are actually liabilities that the company has to pay and settle within 12 months. So what happened is that we take current liabilities, which is 354,970. This is for 2022. And as for 2021, we just take this figure, which is 356,434. Okay, from there, we can actually calculate the fourth current ratio of today. Okay, current ratio usually is actually measured in years. So what happened is that we just take I13 divided by J13. And there you go. We have this figure, which is 2.4. So what does it mean? It means to say that this company has enough current assets to actually pay for 2.4 years of current liabilities. Okay, so typically for investors, we will actually be looking at current ratio in this angle. We don't want it to be super high, but we don't want it to be super low. Okay, so current ratio, if let's say is 1, it means to say it has enough current assets to actually pay for its short-term bills, short-term liabilities for 1 year. Okay, if it's 2 years, that will be good, which means to say, okay, it can actually last for 2 years when it comes to this. But if you have a situation where current asset, not too much, but there's a lot of current liability and the current ratio is less than 0.5, that means to say this kind of company, right, is actually quite close or more at risk of becoming financially in trouble. So you don't want it to be below 0.5. But if it's 1 and above, that would be good. Okay. Now, what you want to do is that you want to actually see the past 10 years track record for this so that you can tell whether or not you can tell a lot about the company's management when it comes to its finances. So to do that, I already compiled the figure. So let's just get that. Okay. So which is over here. So all you need to do is just take these figures, all right, put it over here, and scroll up. So as you can see, when it comes to its current ratio, all right, it's always above 2. All right, there's 1 year that's hitting 3. So which means to say, when it comes to the short-term liquidity, there's no issue for this company. So with that, that is actually the fourth financial ratio. With that, let's move on to the fifth one. Okay, the fifth and final one. Now, when it comes to the fifth and final one, okay, we want to actually measure debt levels. So how do we do that? How do we measure debt levels? So the first one is that, what you can do over here is very simple, okay? There is a shortcut way and there's a long cut way. So the shortcut way, okay, there are many ways to actually do this, but I'm going to show you one way, okay? So the one way is this. What you can do is that can you see that there's here loans and borrowings, 58655, and we have loan and borrowings here, which is 146754. Okay, so what you can do is that you can add these two figures. So I'm going to just add it with I'm going to use a smartphone and add it together. All right, or I just copy and paste. Okay, so we have 58655. And then we have this figure, which is 164754. So if we add it up together, it will be 223409. Okay, so it's actually this figure. All right, and now we actually continue on with 2021, just to demonstrate it to you one more time. You take this figure, 65300. And then we have this 102,120,961. You add it up together, then you have a borrowings of 186,261. So the question is this: why is it that there is borrowings at the non-current liability section and there are loans and borrowings at the current liability section? So the answer is very simple. The first one, this loans and borrowings at the current liability section, it simply means that these are loans and borrowings that need to be settled within 12 months. And as for these loans and borrowings at the non-current liability section, which means these are borrowings that you can actually settle them 12 months later, all right? 12 months later from this date, which is 31st December 2022, okay? But in total, if you add these two up, the amount of borrowings is actually this, okay? So that is actually the case, all right? So we have loans and borrowings, all right? Okay. Now next, let's move on to this. Now next, knowing this amount of loans and borrowings is actually not enough. What we can do here is that we want to know, sometimes when it comes to debt, right, we want a company to, okay lah, I mean to say, how, in order to measure debt, what we want is that a company to have operating cash flow that can support the debt. We want to know the debt repayment capability of the company. So how do we do that? We do that by actually looking at the company's cash flow statement. And at the cash flow statement, what I will do is this. I'll go all the way down to this figure, okay, which is net cash from operating activities. So here, what it says here is that from his business operation, Tongguan has actually made 64.9 million in 2022. He has brought in cash inflow, 64.9. In 2021, it has made 51.1 million in terms of operating cash flow. So we want to actually compile this figure. So let me just compile this figure. Okay. Six. All right. Now, what we want to do is that we want to compare. We want to see, okay, this company has been making this amount of cash flow. How long does it take? So we want to actually measure how long does it take for this company to actually pay off its loans and borrowings. So in order to do that, we just actually come up with this, how I say, this ratio where we are comparing long-term borrowings with its operating cash flow. So put it as years. So what we do is that we take its, so for example, so what I'm trying to say is that, let's assume that I'm the one lah, okay? I'm the one in debt. And let's say I have $300,000 in debt. And if I can make 100,000 in cash flow every single year, which means to say my debt repayment capability is 3 years lah. All right, because I have $300,000 in debt, but every year I can make 100,000. So I can actually pay off my debt in 3 years. So this ratio is actually exactly what it means. So what happens is that I take its total loans and borrowings, which is N13, and divide it by O13, which is operating cash flow. So here it says that, oh, this company can actually pay off its debt within 3.44 years. Okay, so all you need to do is just make sure that these figures are actually stable. Then it's stable and low, then that should be fine. Now let's see whether or not. Now let's just go back to the last puzzle to actually complete my collection of financial data. Okay, so with that, I'm gonna just take this, put it here. And I also have the operating cash flow figures. And now I just scroll it up. I don't need this two anymore. So this is actually what I figure out. So when it comes to operating cash flow, can you see that the company has been most of the time positive in terms of operating cash flow? Now here I will sidetrack a little bit here. When it comes to operating cash flow, you want this to be always in a positive figure. And you always want this to be in a positive figure simply because only companies that have positive operating cash flow can invest to grow the company and can also use the money to pay dividends. If you find that a company is always growing in terms of its profits, but it has negative operating cash flow all the time, that's a red flag. Profits growth must always be backed by operating cash flow. So that is actually key. All right. So that is actually one. Now, when it comes to comparing loans and borrowings with operating cash flow figure, okay, so it's just 1 year that has negative cash flow, but most of the time, the figure is actually not very high. So which means to say that in terms of its debt repayment capabilities, it is actually quite okay. All right, so that is actually the company. Okay, so now we have actually calculated 5 different ratios. The first one is actually net profit margin. The second one is the compound annual growth rate for its profits and sales and profits. The third one, we have actually calculated return on equity. The fourth one, we calculated the current ratio. And the fifth one, we actually compare the long-term borrowings or the borrowings of the company, loans and borrowings of the company with its operating cash flow. Okay, so that is actually the 5 key ratios that I would like to impart to you. And this is actually the thing that I do for each and every single stock that I consider that I'm considering to invest, so that I can make better investment decisions from it. So this is actually my basis of making good investment decisions. Now let's go back to the slide. So we are done with the live demo. Now let's move finally to the final part of this webinar session. So what's next? Okay, so this is actually the flow chart. Okay, so in Malaysia, we have about 900 plus stocks listed in Bursa Malaysia. Okay, there will be stocks that do not meet the criteria of a financially solid stocks. So if let's say the stock is not good in terms of its fundamentals, we dismiss it. From these 900 stocks, we just pick the 30 stocks that are really good. From them, once you have actually done this, once we have done this and we find that the company is good, the next step is to actually calculate its PE ratio and dividend yields. From there, we can actually identify whether or not the stock is undervalued, fairly valued, or overvalued. Okay, so if it's overvalued, then we just keep it in the watch list. But if it's undervalued or fairly valued, then we may actually consider whether or not we should invest or not. Okay, so that is actually how I personally make my own investment decision. Okay, so here are some key takeaways when it comes to this webinar session. Number one, smart investors read financial statements, others may not, which is most of the people in the stock market. Number two, we always want to find companies that grow profits consistently simply because we can actually achieve 2 things. Number one, recurring stream of dividend income and capital growth. Number three, when it comes to financial statements, The reason why we read them is simply because we want to find information about the company's profitability and its financial resilience. When it comes to profitability, we will be focusing on sales, profits, and operating cash flow. When it comes to resilience, we focus on current ratio and its debt levels. Okay, so these are the key takeaways from this webinar session. Okay, so with that, I have actually counted whatever I need to cover. I know, Shane, I mean,
Yes, we still have time for question and answer.
My goodness, I took up a lot of time. Hopefully,
No
you guys
problem.
Back to you, Shane.
All right. So let's do a quick question and answer session. So thanks so much, Ian, for sharing with us what are the 5 key ratios that we can use to assess the health of a company. So if any question for Ian, please write them in the Q&A box. All right. So write them in the Q&A box, not the chat box. Okay. So the first question here is, do you not include lease liability as part of the debt? Then after that, do you also not include trade and other receivable, trades and other payable as well as part of that? Because they also need to be paid within 12 months. Any reason for excluding them?
Oh, we did not exclude. We already include them. So let me just go here. So the thing is that, okay, let me address the easier one. Okay, the first one is actually the what you call the trade payable. So the trade payable is actually under here, which is current liability. So trade payable is under current liability. So here, since current liability is something that we need to pay within 12 months, right? So what happens is that we just measure short-term liquidity. So here we will just take current assets and we just divide it by current liability. So that is actually how we included the trades payable in the equation when it comes to measuring the fundamentals of the stock. So that is actually one. And the next one would be lease liability. Now, lease liability is actually a funny one because most these days, right, because of the accounting change, this liability is about, let's say, for example, I rent a shop. Now that shop rental, right, becomes a lease liability. So does it incur interest? Most likely not lah. So what you want to do is that if that is actually part of this liability, then you may want to actually exclude that from the one which is more pertinent. The one which is more pertinent is actually loans and borrowings, because these are the ones that are interest bearing. So we want to differentiate the ones that are truly a liability, which is the one that will cost you money, cost you interest, from the ones like lease liabilities may not. And even worse, deferred tax liability. As long as their tax consultants give them the right advisors, deferred tax liability, no interest. So it's a good liability to have.
All right. Thank you so much, Ian.
Okay. Next.
Hope that answered the question by Amir. So the next question is by Ricky. Now, Ian, you have talked about profit growth, the ratio, talk about profitability, resilience, right? So what about the ratio for us to evaluate whether this stock, is it undervalued or overvalued?
Oh, that's not part of the webinar, because the first step here is to actually have the 5 key ratios. We make sure that the stock is actually very good when it comes to its fundamentals. Once we got that soft, you see this, once we got the fundamental quality soft, then only we talk about valuation, but it's not actually part of this webinar for, at least that's what I prepared for this webinar lah. So which means saying the first step is to actually, when you go to the market, right, like the fish market, make sure that the fish is good first. Once the fish is good, then only we talk about bargaining the price.
All right. So
just to know how to look for good fish.
Okay, understand. Thanks so much for your input, Ian. All right. So you want to learn more? Okay, register for our next session with Ian. Okay. Now, some common questions that people may find is that, Ian, I have done the homework. I have done all the assessment of the 5 ratios that you mentioned, but one of the ratio turned out to be bad. The other 4 meet my criteria. What should we do?
Oh, it depends on what is the bad one. No? So like, for example, let's go into this because this one has many variables, okay? Many variables. So like number 1, you can have stocks that have actually reported increasing sales. Stocks have reported increasing profits at profit margin. So here they look very good, okay? But then the operating cash flow sucks. It's always on the negative. Then no. Then the answer is definitely no, okay? So these 3 So sales, profits, and operating cash flow must be in alignment. So that is actually number one. Number two, if the return on equity is actually dropping, then it depends on what reason lah. Okay, what is actually the reason? It can be many, many different type of reason. That one is a case-by-case story. So that is actually one. But if let's say, for example, we have debt that is going out of proportion, current ratio is going below 0.5, then I would say that is actually a red flag. I believe that there are many variations to this question on how I can actually answer them. But then given the time limit, let's just say it's best to actually have all five lah. And if let's say you're not comfortable with one of the ratios not being met or being fulfilled, then just move on to the next one. There's 900 stocks for us to choose in the stock market. So we don't need to actually be so hard up with the one that that failed.
All right, so much. Thank you so much, Ian, for sharing with us 5 key ratios to assess the financial health of a stock. Thank you so much. So, ladies and gentlemen, you just heard from Mr. Ian Tai, who is a content creator on kizilao.com.